Welcome back to All Things Money. I'm David Blain, and before the break we were briefly introducing you to the topic of gold, and we're going to give you my outlook on gold. Gold is up about 19% year to date. It's above $1,300 an ounce, and it's actually at its highs for 2010. And so the big question, on the one side you have people saying, oh, it's at its high, it can't go any higher. And on the other side, you have people saying the world's coming to an end, invest in gold. And our take on it is that the recent high will not mark its peak of 2010. I'm not really making any prediction about the next 5 or 10 years, but what we try to do is stay in harmony with the trends that are occurring. And if you look back in history, the trend for gold at the end of the year is very positive. That typically September is the strongest month of the year for gold, and October is often the weakest. Well, we would view a weak month in October for gold as actually a buying opportunity. Many investors are questioning whether the run in gold for 2010 is done, but we think it isn't. And the reason we don't is simply by studying the data. If we look at since 2001, gold has gained every year since 2001. In 01, it was only 3%. 02, 23. 03, 19. 04 was 6. 05, 06, 07 were in the 17 to 25% range. 2008 was 10%. 2009 was 24%. So it's gained every year. What's interesting about, if you dissect the gains of gold in those years, almost all the gain in those years occurred in the months of November and December. It averaged 2002, 3, 4 were in the 40% range. 2005, a full 61% of the gain was in November and December. 2008, all the gain in gold was in November and December. This consistent year-end run of gold is quite consistent, especially when you consider that looking at each one of these years, as the beginning of the fourth quarter started, gold was often at its high for the year as well. So not only did the majority of the gains occur in November and December, but starting out the fourth quarter, gold was often at its peak. So some of the patterns we'd like to highlight are two main ones is that gold, in fact, in 2010 is sitting at its peak for the year, and that has been the case in the past several years. 6 out of the last 9 years, December marked the peak price in gold. So we think it's too early to count gold out for 2010. So then it begs the question of, well, is this just some random anomaly and data mining where you've just looked at the data, and if you look at it, stare at it for long enough, you'll see a pattern? Well, we don't think so. That there are two common reasons attributed to the strong year-end cycles in gold. The first one is the stock market, and the second one is jewelry buying. Both likely impact the price, but we happen to think that jewelry buying is the main culprit. And a lot of this data on the cycles of gold comes from my friends down at Ned Davis Research, who put together a lot of this research for me. And they point out that September has traditionally been the worst month of the year for stocks. And so they typically think that gold is a counter-cyclical play to stocks, and so therefore it would be what we call the anti-risk trade. And that may be the case for September, but it doesn't explain the rest of the year. November and December are two of the strongest months for the stock market also, so you would not expect the gold market to be as strong, as an anti-risk trade if the stock market is going up. So we're not sure that that is an answer. Also, October is usually very volatile for stock markets, yet gold does not usually do that well in October. So once again, this anti-risk message, to me, does not resonate fully as to the reasons for gold's strength at the end of the year. So that leaves us with jewelry. And I know even with the speculative interest in gold and people putting in their safe deposit boxes and investments such as ETFs, which we use to purchase gold, still roughly 50% of the gold demand in the world comes from jewelry. And there's that pesky little thing that you hear me mention all the time. The thing that determines market prices in a free economy is supply versus demand. And so whenever you're looking for pricing information, you should always look at the supply and the demand side of it. And so we still have a demand from people with a doomsday scenario, people hoarding gold, but fully 50% of the demand comes from jewelry. Over half of that 50% in turn comes from India and China. And China is fast becoming a major player in the jewelry arena. Traditionally, India has been the primary driver of jewelry in the world. And the gold buying and jewelry centers around two main festivals that they have. One occurring in late April to early May, and the other one occurring mid-October to mid-November. So you have these two jewelry buying, quote, seasons in India. The second one also happens to coincide with a large wedding season in the Indian culture. And so this end of the year gold buying festival is typically cited as a reason for gold's year-end strength. The 5-day festival is celebrated by most Hindus, who make up about 80% of the India population. And they show that the jewelry demand does tend to rise around the fourth quarter. If we look at it specifically, this festival starts this year in the week of November the 5th, so it's a little bit later this year. And typically, if you look at all the years after the conclusion of this festival, we see a large rise in the price of gold. So that's our take on gold. We'll take a short break now. And when we come back, we'll get to some of our listeners' and viewers' questions. For All Things Money, I'm David Blain.